Welcome to Chapter 2 in your Cornerstone's textbook. In this video, we're going to introduce how a company uses the accounting system to analyze and record the events that regularly happen in a company. Now what they use is something called double entry accounting. In order to have that, you need to have something called accounts. Accounts reflect the various kinds of transactions that can occur in a company, and inside each account, it records the increases and decreases that happen within it. Each financial statement element has an account. So remember, in Chapter 1 we learned about, for instance, the balance sheet. There are assets and liabilities and stockholders' equity on the balance sheet. Those are all categories of accounts, and inside each category there are multiple specific accounts. We will learn about some more of those on top of what you already learned in Chapter 1 in Chapter 2. Or, for instance, there's the income statement, and the income statement had accounts like revenues and expenses. So we will be covering how each of those specific accounts can actually affect how we record transactions. Now, every company is going to have a chart of accounts. On the inside front cover of your textbook, there is a list of all of the accounts that we will be using during this accounting course. And that's very helpful, and it even tells you whether that account falls on the income statement or the balance sheet or the retained earnings statement. The balance of any account is the amount, the dollar amount in that account at any time. We will also cover a thing called the T account. T accounts are really just a quick sketch of an account with debits on the left and credits on the right. And this is how we analyze accounts. Now, debits and credits. Let's quickly remind ourselves what these are. You need to resist the temptation to think that debits are always negative and credits are always positive. It's nothing like that. Debits occur on the left side of a T account. A T account. Imagine a T. This side are the debits, this side are the credits. Eventually, you're going to be creating journal entries, and always at the far right-hand side of a journal entry, you're going to have the date over here, you're going to have account names over here, and then you're going to have the debit amount or the credit amount. The debit always appears to the left, the credit always to the right. How do you know whether the amount is a debit amount or a credit amount? Well, that has to do with what account is being affected and how that account falls in the accounting equation. So to summarize, debits, always on the left, credits, always on the right. Sometimes they may be increasing an account and sometimes they may be decreasing an account, but the debit is always on the left, the credit is always on the right. So, draw the T account. Just draw a T. Then you need to know the normal balance for that particular account. The normal balance is either a debit balance or the normal balance is a credit balance. Whatever the normal balance is, you will enter that for the increases, and decreases will be the opposite. Now all this probably seems confusing. So let's actually go back to our fundamental accounting equation. Remember that? Assets equals liabilities plus stockholders' equity. That fundamental accounting equation determines the normal balances for the various accounts and whether or not that normal balance is a debit balance or a credit balance. Notice, assets are on the left-hand side of the equation. That means the normal balance for assets, for all asset accounts, the normal balance is a debit balance. That means all increases will be listed as debits and all decreases to asset accounts will be listed as credits. Okay, so remember, assets are on the left-hand side of the accounting equation. That means their normal balance is a debit. liabilities are on the right-hand side of the accounting equation. Their normal balance is a credit. That means all increases to a liability account are credits. That's the opposite of assets. And all decreases to liability accounts are debits. Stockholders' equity is also on the right. That means its normal balance is a credit balance. That means all increases in stockholders' equity are credit entries, and all decreases to stockholders' equity are debit entries. That's the exact opposite of what happens with assets. As a reminder, and this can also be found, a breakdown like this can also be found in your Cornerstone's textbook. Asset accounts, their normal balance is a debit balance. Liability accounts, their normal balance is a credit balance. All stockholders' equity accounts, their normal balance is a credit balance. And remember, on the inside front cover of your Cornerstone's textbook, you can find out whether an account is a liability account or an asset account or a stockholders' equity account. And once you know that, you can remember whether it has a normal balance of credit or debit. Now, stockholders' equity does need to be broken down a bit more. It can be broken down into two main components: contributed capital. This means any additional equity dollars that are brought into a company. And then the retained earnings. And if you recall from Chapter 1, retained earnings are any net income from the bottom line of a company's income statement that it retains. Now, retained earnings can be broken down. It is the balance of the original beginning retained earnings balance from that period, and this is all found on the retained earnings statement, remember. Then we add the net income from that year and we subtract the dividends. Now let's break net income down a little bit more, because all that can be found on the income statement, remember? And the income statement shows us all the revenues minus all of the expenses. Now, stockholders' equity is on the right-hand side of the accounting equation. It has a normal balance of credit. That means any increases to stockholders' equity will cause a credit entry. Any decreases to stockholders' equity will cause a debit entry. Any contributed capital would be an increase to stockholders' equity. Any retained earnings are an increase to stockholders' equity, so they would get credit balances. So any net income is an increase to stockholders' equity, so that's a credit entry. But any dividends, remember, is a decrease to stockholders' equity because it decreases retained earnings, thus it would be a debit entry. In the same way, revenues increase net income, which is an increase to stockholders' equity, so those would be credit entries. And all expenses are a decrease to net income, which is ultimately a decrease to stockholders' equity, so those would be debit entries. Let's break that all down. Contributed capital is on the right. Normal balance is a credit. Credits increase contributed capital. Debit entries decrease contributed capital. Retained earnings on the right-hand side of the equation. So in the normal balance is a credit balance. Credits increase retained earnings. Debit decrease retained earnings. Now, let's move on. Contributed capital. Credit normal balance. Retained earnings. Credit normal balance. The beginning retained earnings amount increases stockholders' equity, so its normal balance is a credit. And any debits will decrease it. Revenues increase stockholders' equity because they increase net income and they increase retained earnings. So the normal balance is a credit. Credits increase revenues. Any increase in revenues is a credit entry. Any decrease in revenues is a debit entry. But expenses decrease stockholders' equity. Their normal balance. Debits will increase expenses. And credits will decrease expenses. That's how we record those. Dividends also are decreases to stockholders' equity. Their normal balance is a debit. Debits will increase dividends. Credits will decrease dividends. So here's how we do it. Remember, retained earnings is the beginning retained earnings balance plus all the revenues minus all the expenses minus the dividends. This was all what we found on the retained earnings statement from Chapter 1. That means beginning retained earnings, because it increases stockholders' equity, it has a normal credit balance. That's on the right-hand side of the equation. Revenues increase stockholders' equity on the right-hand side of the equation, so that is a normal credit balance. Expenses decrease stockholders' equity, which is on the right-hand side of the equation, but since it's a decrease, their normal balance is a debit, and the same with dividends. Now, you need to journalize every transaction that happens in the accounting cycle. They record the debit and credit effects on any account. We call this journalizing. You have to include the date, you have to include the accounts and the amounts, whether they were increased or decreased, and a brief explanation of the transaction. First, you have to analyze the transaction for the effects on the accounting equation. Was it an increase in assets, liabilities, stockholders' equity, or a decrease in one of those? And then you determine exactly which accounts are affected. Again, you can look at the chart of accounts inside your textbook. Then you prepare the journal entry using the debit and credit procedures. Debits are always entered first. All the accounts that were debited will be entered first, and then the credits are below that. The total debits in any journal entry must equal the total credits. Let's look at an example, Cornerstone 2.2 on page 61 in your textbook. Luigi purchases $3,000 of computers from Worst Buy Electronics on credit. On credit means they don't pay cash at that time, but their payment is due in 60 days. Now, first, what actually happens when Luigi purchases $3,000 in computers? Well, Luigi now has more assets, correct? He has a $3,000 computer, which just increased his equipment asset account. Did he pay cash for it? No, he didn't. So he didn't decrease his cash account, which is an asset account. But he must owe something now, right? He has a liability. He now owes Worst Buy Electronics within 60 days that full $3,000. So we would say there was an increase in asset account, a $3,000 purchase of computers, and there's an increase in liabilities. It's a $3,000 accounts payable liability. Because it's due within 60 days, it's not a long-term liability, so we call it accounts payable. Now, let's actually look at how we would journalize that transaction. Knowing that we have $3,000 increase in an asset and a $3,000 increase in a liability account, how do we create that journal entry? Well, Cornerstone 2.5 on page 72 shows us this. Which accounts were affected? Well, we know that the equipment account, which is an asset account, was increased, and we know the accounts payable account, which is a liability account, was also increased. Now, an asset account, when there is an increase in an asset account, that's a debit, correct? When there is an increase in a liability account, what is the normal balance for a liability account? Exactly, it's a credit. So let's journalize this thing. The equipment account was debited for $3,000. The accounts payable account, which is a liability account, was credited for $3,000. Does debits equal credits? Yes, it does. Do I have a date on there? Yes, I do. And did I record a memo as to what exactly had happened? Yes, we purchased equipment on credit. Now this gets your feet wet in how to analyze the effects on assets, liabilities, or stockholders' equity accounts, and then how we use debits and credits and their normal balances to record those in journal entries. The next video will take you through a series of transactions. We will analyze their effects and we will journalize them.